Welcome back to Alpha Recap, your post-market wrap from stockalpha.ai. We're closing out the week with a lot to unpack. Big travel headlines and wild microcap action dominated the tape. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. It was a dramatic session. Two clear storylines emerged, and both matter for risk managers and traders heading into the long weekend.
Let's start with the biggest headline: Spirit Airlines. CNBC reported that talks with bondholders failed and the company was preparing to shut down. That was huge. So, what really stands out here is the operational shock.
Right. A carrier preparing to cease operations is one of those rare, real-time operational events that ripples beyond the equity. Ticketed passengers, cash flows, supplier contracts, all of that gets exposed immediately. Analysts noted that fixed income holders and short-duration credit funds were particularly at risk.
Walk me through the transmission channels. How does a shutdown like that affect bond markets and other airlines?
Sure. First, bondholders face potential losses or delayed recoveries. Funds that were holding airline debt short-term can see mark-to-market hits, and in some cases, forced selling. Second, investor sentiment toward the travel sector tightened. Peers saw transient volatility as traders reassessed sector risk. And finally, there's the operational side. Refunds, dot notices, and any government or industry intervention could set the tone over the weekend and into Monday, May 4th.
So the key things to watch were official filings from Spirit, bondholder statements, and any Department of Transportation notices over the weekend.
Exactly. Those disclosures would either confirm the shutdown path or open the door for some form of intervention. Either way, it was a risk-off event for travel for the rest of the session.
Moving from a systemic event to market microstructure, the tape was packed with heavy volume movers and extreme percent moves, especially in small cap and microcap names.
Right, and the numbers were eye-catching. For example, one mid-cap healthcare name finished up about 100% to roughly $11 on about 45 million shares. Another sub-dollar name printed nearly 80% gains on about 246 million shares. And there were multiple triple-digit percentage moves in the penny name space.
And a lot of that was paired with massive share counts, hundreds of millions in some cases. That changes how tradable the move was, right?
Yes, when you see hundreds of millions of shares traded at sub $1 levels, the move is very tradable in the sense that you can get in and out, but it's almost always retail dominated and mean reversion prone. On the flip side, when a name pops on single digit or low hundreds volume, say 10 shares or 78 shares, that's a liquidity red flag. Those prints can't be relied on as legitimate market interest.
Let me toss a quick list at you and you tell me what stood out. HCAI up about 100% to roughly $11 on about 45 million shares. SOBR up almost 80% to just under $1 on about 246 million shares. And a small name that printed about 120% on less than 1 million shares.
All three are classic but different flavors. HCAI's move had real participation and follow-through potential. SOBR's move was tradable but retail heavy, very susceptible to outsized intraday swings. The tiny volume gap is the risky one. A big percentage move with thin volume can reverse violently when normal liquidity returns.
Quick reaction. Wow, that's wild.
Yeah, that tracks.
And some names triggered trading halts. One example was a large jump into the high 40s, followed by a halt with news pending. Those halts can lock in gaps and create cliff edge risk when trading resumes.
Absolutely. Halts around pending news often precede material corporate actions. When trading resumes, you can get violent repricing. For risk teams, that's a moment to reconfirm liquidity assumptions and stop-loss mechanics because spreads widen and fills can be poor.
Let's talk Microcap Mania. The session had a sweep of penny and microcap tickers printing huge one-day gains. How should listeners think about that environment?
It's a mix of momentum and thin liquidity. We saw names up 100 to 200% on both light and heavy volume. For example, one microcap printed about 139% to $22 on roughly 6.5 million shares, and others jumped over 100% at fractions of a dollar on tiny volumes. Those extremes are often driven by retail scanners, social chatter, and options flow.
Honestly, I was a bit surprised by this one. It felt like the scanners lit up and everyone piled in at once.
Right, and that creates two outcomes. With heavy volume, the move is tradable but tends to mean revert quickly. With minimal volume, you can see massive mark-to-market swings and then wide gaps at the next open. Both scenarios raise execution risk.
Short reactions. Not great for illiquid portfolios. Yep.
Short and painful for some holders, yes.
Switching gears, there were also notable one-day declines. Several names fell sharply, some on meaningful volume. This pointed to forced selling or margin dynamics in a few cases.
Those drops were concerning. We saw a stock cut in half on 10 million shares, another down roughly 38% on close to 20 million, and a few names collapsing with tiny reported prints. The latter can signal custodial or execution errors and are assigned to verify holdings through your broker.
So when you see big down moves in thinly traded names, the immediate checklist is check your broker statements, look for corporate notices, and think about forced selling triggers in funds or accounts.
Exactly. Those events can cascade through stop losses and margin calls, amplifying volatility in correlated small cap strategies.
We should also call out leveraged and inverse ETFs. Products that provide amplified exposure were active and can act as volatility amplifiers.
Right. A small cap bear triple leverage fund was down about 6.5% on a huge volume day in the hundreds of millions. A semiconductor inverse product was down a couple of percent with heavy turnover as well. When these funds trade big, they generate rebalancing flows and can force transient dislocations in the underlying baskets.
Quick explainer for listeners. Leveraged ETFs reset daily and use derivatives and swaps. So heavy trading can force those funds to buy or sell components intraday to meet their leverage targets, which can move prices in the underlying.
Exactly. They're amplifiers, not buy and hold instruments for long horizons. For intraday and short-term sentiment, they're a key transmission channel.
Pulling the threads together, what were the emerging patterns you saw today?
A few things. Retail-driven microcap frenzy at both tiny and massive volumes. Liquidity mismatches where large percentage moves sometimes printed on minimal reported shares. Event risk concentration from halts and pending disclosures. And the Spirit Airlines situation, which raised sector contagion risk for travel and credit. Taken together, data suggests heightened short-term volatility heading into the weekend.
And for listeners preparing for Monday, May 4th, what should they put on their watch list?
First, any Spirit filings, dot notices, or bondholder statements over the weekend. That will likely set the tone for travel names. Second, resumed trading and disclosures for halted names. Those resumption prints can be decisive. Third, follow-through volume in big movers. If the volume dries up, expect a higher chance of reversion. And finally, earnings commentary or analyst notes for some sector leaders that were weak today.
Rapid-fire watch list. Spirit Airlines for official updates. The heavily traded microcaps for volume follow-through. The halted name for news on resumption. A clean energy name that pulled back after earnings chatter. And semiconductor leaders for sector flow cues.
Yep, and just to be clear, this is about monitoring risk and confirming facts through primary filings and your broker. Analysts note these moves as signals, not as advice.
Final takeaways?
1. Spirit Airlines' reported failure to reach an agreement with bondholders was the biggest single operational risk, and it widened travel sector stress. 2. Extreme microcap and small cap volatility, both up and down, increased execution and liquidity risk, especially in thinly traded names. 3. Leveraged products and halts are amplifiers. Watch resumption events and rebalancing flows. And 4. Verify holdings with your broker if you own any names that printed odd prices or near zero prints.
Great overview. Thanks, James. Quick wrap. Listeners, remember this content is informational only. We're not recommending buying, selling, or holding any security, and this isn't personalized investment advice.
Exactly. Use primary filings, broker statements, and your risk controls. Volume, halts, and corporate disclosures were the key signals today.
If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening. Have a safe weekend, and we'll see you Monday after the open.